Please join me in welcoming David Johnson and Robert Kaplan.
It's good to have you in town. I've been following your travels. So I know you were in San Antonio yesterday. I saw you on CNBC, and you were talking the Economic Club, Monday, Tuesday? Then you were in Asia. Then you went to Mexico.
Yep.
How do you get all that time off? Talk about what you do, though. I mean, that's one of the things that Neil said.
So, we have 1,300 people at the Dallas Fed. We have 12 Federal Reserve banks in the United States. We're one of the 12. But we do a number of things at the bank. We supervise all banks and regulate banks in this district. We oversee payments in the United States Treasury Services. We have a big economic staff. And what I spend a lot of my time doing is being out somewhere in the district and trying to understand economic conditions, not only in this district, including energy, but the United States and the world. And we have a very strong relationship with Mexico. We're the largest exporting state. Texas is the largest exporting state in the country, and Mexico is our #1 trading partner, so we go back and forth regularly. And the reason I went to China, I used to live in Asia and run a business in Asia. When I was on Wall Street, and China I go to because of all the countries in the world that I think has spillover risk to the United States. China is at the #1 on my list, and so I think we've got to go there and understand it, because it is certainly, I think for the remainder of my time at the Fed, it will be something we have to always consider.
Wait, that sounds like something I need to know. Spillover risk.
Yeah.
Explain to me what you mean.
So spillover risk means I'm a central banker for the United States. My responsibility is the United States, but and tonight's a great example of it. As you all know, the issue is today, unlike say 30 years ago, the world has never been more interconnected. So economies are interconnected, global supply chains, logistics, goods go back and forth across the border. We're very integrated, but financial markets have never been more integrated. I'm sure everyone in this group and portfolios you work on, 30 years ago you could have mainly a domestic portfolio. Today it's got to be global. So what does that mean? It means that if there's turmoil in China because of overcapacity, high levels of debt, currency turmoil, financial turmoil there can very quickly cause global financial turmoil, which it did in the first quarter of this year.
Right.
And then tightening of credit conditions in the United States, credit spreads widening to where we actually have to respond to it. And that happened just 8 months ago. Seems like a long time ago, but it just happened this year, and it's got to be a factor in our thinking, being central bank of the United States.
Well, there are the positive aspects of globalization and obviously the negative, the pitfalls. Right. I'm going to come back to that because we want to talk about India in particular. But look, I've really been looking forward to this. I always enjoy our conversations, but particularly now, this has been an absolutely remarkable 3 weeks. Yes, I've watched the Dow go up 1,000 points. I've watched the bond market absolutely get crushed. The bond market, the marketplace has done your job. They've already raised the interest rates. The Fed's going to be, an after the fact. And I've watched the dollar gain strength against everything.
Yeah. So you keep saying the markets have done our job. We just talked earlier, but and you know what I'm about to say. So my career for the last 30 years would be to try to handicap what was going to happen, and then position financially to anticipate it.
Right.
My job as a central...
We're talking about at Goldman Sachs.
That's right. And even running a hedge fund, which I did as chairman of a hedge fund. My job as a central banker is a little different in that my job is to take into account financial conditions, but primarily to the extent they affect underlying economic conditions. And I know from experience, and you do too, that when the markets move this way, sometimes they move this way, and then they go this way because events unfold, and sometimes the market anticipates them correctly, and sometimes it anticipates them incorrectly. My job and our job at the Dallas Fed, and the Fed generally, is to understand economic conditions in this district in the United States. And I need to be patient, and particularly into 2017, I'll need to show patience to wait to see what actually unfolds, because it may or may not be what we anticipate, and then see how that affects economic conditions, and then we'll adjust economic policy accordingly.
But it really looks like, it's not different this time, but it really looks like there may be a sea change going on right now. And I know we can't go by one economic indicator
Sure.
and everything else, but we had the employment numbers that came out today with the Deputy Secretary of Labor on the show tonight. And he says the numbers are real. He swears it's not an aberration that the unemployment rate really did drop to the lowest level in 9 years, and that the unemployment rate, specifically with adult males, is like 4.3%. And I don't see the inflation coming, but usually you see wage inflation coming with that, and there's some negative consequences.
So this has been the story going on all year. So if you actually look, it seems like we've been up and down this year. If you take the average job growth for the first 3 months, 6 months, 9 months, all year in 2016, and then to today, it's averaged about 175,000, 180,000 jobs. So it's interesting, the number that came out was right at the average. Now, what's been going on is the participation. So we don't look at just headline unemployment, which is 4.9%, was before today, now 4.6. We look at other measures of labor slack. You know, how much room is there in the economy? We look at discouraged workers, people working part-time who would rather be working full-time. And a number of other, and we look at the participation rate. Lots been made of that. It was 66% in 2007. It is 62.7 as we sit here today. It actually ticked down. So what's gone on is we had 180,000 jobs plus or minus. The unemployment rate went from 4.9 to 4.6. Part of that was because the participation rate went down. So why is that? What we believe at the Dallas Fed in doing this work is this participation rate has been gradually declining. And I'd love to tell you that a lot of it is cyclical, but our own judgment is a substantial amount of it is based on aging demographics, i.e. people are aging out of the workforce.
That's an important point. I don't want to interrupt, but I mean that, because 3 years ago they were saying people gave up because they knew they couldn't find a job. Now they can find a job if they want it. Yes,
and so what we're seeing is participation rate is, anyhow, is down to 62.7. And the long and the short of it is if you project out another 10 years from today, because of continued aging of the workforce, this is, by the way, going on in every advanced economy, we think the participation rate will be below 61% within the next 10 years. So what's that mean? Creates a headwind for GDP growth. Why has GDP growth been so disappointing over the last several years? One reason is the household sector in the United States has spent the last 8 years deleveraging. They were historically highly leveraged in 2008, and it's taken this many years for them to deleverage. But while that deleveraging is heavily behind us, we've got a new headwind, which is the workforce is aging, and people are aging out of the workforce. So without other policies that would grow the population or grow the workforce, unless there's a burst of productivity, that's going to have real headwind for GDP growth.
But then we don't need to worry about onshoring jobs. We need the world workforce, it sounds like.
Well, so one of the things we're going to learn about as we head into 2017 is there's a debate in this country going on, how tight is the workforce? And there's some people that say, boy, hey, come on, 4.6%, it's phony, and there's lots of slack. Our own analysis of that, and I was actually, in some ways, when I got into this job 14, 15 months ago, I was kind of hoping to find that was true. But I must tell you, my analysis and our analysis is, we think, in fact, that because of aging, there is more slack. I believe there is more slack than people may think, but it's less than is widely believed. And so if we're not at full employment right now, we're making good progress toward getting to full employment. And in addition, the inflation rate is beginning to approach, core inflation is beginning to approach 2%. So because of us reaching our dual mandate or making progress, that's why I've been advocating that it's time to remove some amount of accommodation, i.e. raise interest rates in the very near future.
Well, there's going to be a real challenge then to get to the growth rate. One of your fraternity brothers from Goldman Sachs is a candidate to become secretary. I think there's just a logical progression. Bob Rubin or Hank Paulson, or you happen to miss that, but presumably Steve Mnuchin becomes the Treasury Secretary, and he's talking 3 to 4% growth. How do you get 3 to 4% growth in an economy?
So I'll put it this way. Here, and I've been talking about, here are things that we could do that would be helpful. First of all, actions that improve productivity, infrastructure spending, incentives for greater capital spending, you would hopefully improve growth, increase vocational training,
right,
and early childhood literacy. We don't talk a lot about it, but we are lagging in terms of educational attainment levels. We need to nationally focus on that. That would help improve productivity. In addition, regulatory review at the state, local, and federal level, I think that would help improve productivity. But things that turn out to be investments in people and in infrastructure should be things that ought to help improve productivity, which would sustainably, keyword sustainably, increase GDP growth.
And meanwhile, international trade, what's the component?
There's something like 11.5, 12 million jobs in the United States that are basically reliant on exports. So trade, we're 5% of the world's population. Trade is critical to the United States. Obviously, it has to be on a level playing field and all the discussion about that. But we do a lot of research on our trade relationship, for example, with Mexico. It is our analysis that 40% of the imports from Mexico to the United States, 40% of the content of those imports is U.S. content. So you say,
it's coming back.
Say, what is that about? It's because it's production, it's an integrated production partnership, it's integrated logistics, and we believe strongly that that partnership increases Texas competitiveness and U.S. competitiveness, and if we didn't have it in this hemisphere, we would lose those jobs to someplace else in the world.
Doesn't sound like a trade war is in our best interest.
What we try to do is stay away from the politics at the Dallas Fed,
Well, is that
but focus on the facts and our analysis, which people can debate and disagree with. But our belief is trade and some of these partnerships are helpful to creating jobs here and improve competitiveness.
Let's go back. We promised we want to talk about India a little bit. And again, my study, I know you all know all about this. And again, you were head of the Asia Pacific investment banking for Goldman Sachs.
Yeah.
Lived there for a long time. You know the area, you know the entire area. What the hell is this demonetization business? How can you just tell somebody that the money you have, that you've got a 500 rupee, note that's no good?
Yeah. Yes. So,
is there a precedent for that?
that's a good question. India. First of all, India is one of the bright spots in the world in terms of GDP growth, and you look at countries in the world that are growing at high rates. India is right at the top of the list. But part of improving is reforms, and in India, and we talked about it a little earlier, the speaker talked about it, one of the reforms that India is trying to address is, for lack of a better, corruption, how some of these currencies are being used because they want to discourage it. So what you find is when a country goes through these kinds of reforms, it can be painful and can be disruptive because people have to adjust to it. And so I applaud and understand what India is trying to do. Obviously, when you're trying to do these things, the execution of it is challenging, and I think that's what we're seeing.
We saw that here. You remember the Saturday Night Massacre? I don't know. A lot of you probably remember. Paul Volcker raised interest rates in this country 1%, 100 basis points overnight.
Yeah.
And blindsided everybody. And that was really painful. But he was trying to break the back of inflation.
Listen, surprise in any of these actions and reforms, monetary policy, you name it, is challenging. But you've got to admire, I will say from sitting here, you have to admire the courage of the leadership of India to try to attack these reforms and make improvements. So I understand and respect what they're trying to do.
Let's come back home. We've watched oil. It bottomed out, I guess, at $26.38,
Yeah.
whatever. Maybe we'll
All
never
this
see
year.
that again. Yeah. And now back, not that comfortably above 50 on West Texas Intermediate.
Yeah.
I know your district doesn't really live and die by oil, contrary to popular
But we
belief.
study it heavily here at
But
the
it's
Dallas
really
Fed.
important.
It is. Listen, it's on the one hand, and this is pretty devastating, energy industry was 13% of Texas GDP in 2014. It is down to around 6% today. So some of that is because of weakness in energy. Some of it is a positive story about the growth and diversification of this state. And the story of Texas has been migration of people and firms here, and so the state is really diversified. But back to energy. Energy can provide a very healthy tailwind here, and it's our judgment, even before the deal Monday, or earlier this week, or Tuesday, I guess it was, we thought global supply and demand of oil was going to get into balance by the first half of 2017. Obviously, the arrangement made at OPEC, if it's executed, will accelerate that. It's been our view that given this firming, this balancing trend, you're going to see prices continue to firm, which even though they've been volatile, they've been firming, and we think this will accelerate that firming. And if you look over the next 3 to 5 years, we think global demand is growing in 2016 at about 1.3 million barrels a day on average. We think it's going to grow at least a similar rate in 2017. The reason we're getting into balance and starting to work off excess inventory is not that supply is coming down, it's demand is caught up to it. And so if you look over the next 3 to 5 years, I'm actually very optimistic about the prospects for the energy industry, which will ultimately provide a tailwind. It's been a headwind for most of this year and the last 2 years. It's probably getting to be neutral now, and we'll probably get to the point where there'll actually be a tailwind for the state and for the district. And that makes people happy here.
I never thought, as a Texan, I know oil is important. I want high oil prices.
Yeah.
It helps all. But the thing is, I never really thought that falling energy prices would be a bad thing. I guess I never realized how many people, what the ripple impact is of something
So this has been a good case study on what's the impact on the U.S. economy. We know locally in the state the fall in energy prices, the loss of capital spending, the loss of jobs. We know net it hurts this state. Even nationwide, because it's the sizable drop, the drop in CapEx occurs right now. The loss of jobs occurs right now. The benefits of lower prices, consumers experience every 2 weeks, a fraction of it as you go to the pump. And I think what we've learned this year is because the negative effects are immediate and the benefits take time to realize, and also consumers are not sure they're going to be recurring, what we found is there's been debates about how much of the energy savings consumers have actually spent.
Is that true with interest rates too? But why am I suddenly cheering for higher interest rates? I mean, interest rates have dropped and dropped. And it puts, money in corporate hands, and it allows people to buy houses that couldn't otherwise.
So lower interest rates is also a mixed bag. We know on the negative side it penalizes savers.
Yeah.
Okay, we also know on the negative side it incentivizes people, which we wanted to do for several years, but maybe not at this point. It incentivizes people maybe unduly to take more risk. It can distort real estate markets and other markets because cap rates get very low. And obviously it tends to cause people to be more inclined to buy financial assets. So when it reverses, if it happens gradually, people can adjust to it, much like the demonetization.
Right.
If it happens very suddenly, which you've had, if this trend continued, I'm sure there's going to be some dislocations because people just can't adjust fast enough to this level of dislocation.
We're not going to talk politics, and I don't want to talk politics.
Thank you.
And I won't do that. But the thing is, and I watched, because I've heard you talk about this before, so I know I can bring it up. But entitlements, that's one of the things that the Fed really seems to care about. And if you guys were going to lobby congressmen and senators, I guess it would be that. I didn't hear anybody talking about entitlements.
No. So there are four big trends, and I said one already. Aging demographics is a mega trend. It's affecting the United States. It's affecting advanced economies, and we care about it because it creates a headwind for GDP. Another big trend is I call the end of the debt super cycle, which means for most of my lifetime in the United States, for example, we were able to use fiscal policy, i.e. putting on more debt, in order to stimulate growth, either infrastructure spending or taxes or other fiscal policies. We now have 76%, we now have 76% of GDP is debt held by the public, okay? And the present value of future unfunded entitlements in the United States is $46 trillion. You combine with that an aging population where the number of workers to support the number of dependents is shifting. Less workers, more dependents. And this is why I've said in most speeches I give, it would be a healthy thing if we did some restructuring of entitlements, which should not affect people, by the way. You pick the number 50 years old and above. We could do it for future generations, either raise the retirement age or means test, and I won't get into it because it's not for me to get into, but the point is, there's no question that this level of debt to GDP, there's a question about how sustainable it is. And this will be a question as we head into 2017. If we were to increase that, we're already at a point where there's a question about sustainability of debt to GDP, and that's why we talk about it.
Well, but nobody else is, are they? Did I miss it? Did this subject come up during the political?
It came up. No, there hasn't been a real mandate from this to address it, but the reason it matters is, I think, psychologically. We know most Americans are either don't have savings or are undersaved for retirement. Also, in the back of people's minds psychologically, people are not, it's not invisible. And there's studies that have been done because the public is aware of the amount of debt and entitlements. They modify their behavior in anticipation of it. And so I think this is something, you're going to see the U.S. budget deficits begin to, even without any further policies, according to the Congressional Budget Office, they're going to begin to go like this over the next 5 to 10 years because these unfunded entitlements are going to work their way into the annual budgets. And this is going to be, I'm confident, a very front and center topic in the United States as those underfunded entitlements start finding their way into the current budgets.
One last thing is, like I said, you've traveled a lot, and you traveled throughout this district. You were down visiting your bank in San Antonio yesterday. What are people talking about? What are they concerned about?
Obviously, in this state, at least, obviously there's the natural local issues, energy.
Yeah.
We talk a lot about the migration of people and firms to the state, and I think Texas is a great story, and I'm very optimistic, as I said, about the future of Texas. But then they're talking about what's going on in the country. And the big things we're talking about are how really tight is the labor market?
Yeah.
Why is inflation remain so low? Why is GDP so sluggish? And a lot of the things I talk about, particularly when I go to mid-sized towns like a Wichita Falls, which is stable population but not growing, we talk about globalization, we talk about demographics, but we talk about one other thing, technology-enabled disruption, i.e. Amazon or Alibaba versus retail, Uber versus taxis. Every industry out there is being disrupted. And I think a lot of these small, mid-sized towns are losing population. Part of it is cultural and the fact that we're not growing the workforce, and so there's a war for population. And part of what's happening in the country, some of the loss of jobs is not trade. It's being attributed to trade, but a lot of it is also technology-enabled disruption, and sometimes we sort of mix all these up. And so I think people really appreciate talking through what are these big trends and maybe helping them diagnose what might be going on in their towns.
Let me ask you one last thing. I said one last thing. But at a gut level, what I hear, I think I've come to realize that 2008 and 2009 scared people even more than I thought it did.
Yeah.
And I've watched the savings rate go from a negative 0.5% to, I think the last is 5.7. And the retailers keep wanting to know why people aren't coming. And because they always, every winter, even though you had a serviceable blue coat, orange was in, so you bought an orange coat. They're not doing that anymore.
Well, so here's what's going on. First of all, wage rates have been sluggish
Yeah.
for a typical worker, middle-class worker, for a number of years. And the second thing's happening. While a worker may feel that he or she doesn't have a lot of negotiating power at work, got a lot of negotiating power when they shop. Because technology has allowed them to walk into a store, check the price online, and buy a product online from somewhere else while they're standing in a store looking at a product price. And so what's happening is, slowly but surely, retail is being eroded, and this trend is not changing. This is going to continue.
So they're buying stuff, they're just paying less, or they're
You bet.
bargaining more.
They're shopping, and technology has enabled them to shop. And what the impact is pricing power in my life for businesses has never been lower. The power of consumers has never been stronger. And this is part of why I believe CapEx spending in the United States has been sluggish. Business leaders know they're not only worried about sluggish demand, they're worried that the businesses they're running might get disrupted, and why invest in a model that might become a dinosaur? And so it's a very complicated, and the last impact is on workers. People, in my generation, we had it much easier, yours and mine. Young people today, and I tell my students this, are more likely to fire people, are more likely to get fired in their career, and much more likely to need to change careers and get retrained. And the country has got to catch up to that. We need more vocational training. We've got to do a much better job to help people make the adjustment, because these trends are disrupting people and they feel it.
And this is a community that really cares about that and can do a lot about it. And you all are very attentive. Thank you. There are a bunch of salmon that are sitting outside the ballroom door trying to get in here. I always enjoy it. We'll continue this Monday night.
Good to talk to you, David.
KRLD.
All right,
Thank you very
thank you.
much.